Investing can seem complicated, especially when there are countless strategies, asset classes, and advice available. But the truth is, building wealth is less about timing the market and more about step-by-step order, about discipline and consistency. By knowing exactly where to start and what to prioritize, you can invest your money efficiently, reduce risk, and maximize long-term growth. This guide will walk you through the best order step by step to invest your money. Step 1, build an emergency fund. Before you can invest a single dollar, it's critical to have a safety net in place. Life is unpredictable. Job losses, medical bills, car repairs, and other emergencies that can happen at any time. Investing without an emergency fund can force you to sell investments during market downturns, locking in losses unnecessarily. You always have to prepare for a rainy day. A few key points. Aim for 3 to 6 months of living expenses in a savings account or money market account. Obviously, you want to get the highest interest possible on this account. So keep that in mind. Keep this fund liquid, meaning you can access it quickly without penalties. The exact amount depends on your job stability, monthly expenses, and personal comfort level. An emergency fund provides peace of mind and prevents you from making emotional or rushed financial decisions. Think of it as your financial foundation. Everything else builds on top of it. Step 2, paying off high interest debt. Once your emergency fund is secure, the next step is tackling high interest debt, such as credit cards or payday loans. High interest debt is one of the biggest barriers to wealth because of interest that compounds against you. Paying off debt with a 15 to 25% interest rate is essentially giving yourself a guaranteed return equivalent to that interest. A few key points. Prioritize debt with the highest interest rates. Those should be tackled first. This is also called the avalanche method. I have another video on it, so be sure to check that out. Next, make sure at least the minimum payments on all debts are paid to avoid penalties. Avoid accumulating new high interest debts while investing. The goal is to get out of debt and invest. The only thing, basically you want to start with the highest interest debt first, pay it off, prioritize step by step until they're all paid. By eliminating high interest debt, you can free up cash flow that can be redirected into investments with higher growth potential. Step 3, contribute to retirement accounts. With your emergency fund ready and high interest debt paid off, it's time to start investing in your future through retirement accounts. This includes accounts like 401ks, IRAs, Roth IRAs, and other employer-sponsored plans. Opening these accounts and being tax efficient is key to success over the long term. And contributing to these accounts harness the power of the compound effect, which is extremely important. You want the compound effect working for you. That's once you get all the debts paid on your credit cards, you move into working where compound effect is working for you, and that's where you see a major gain overall. Consistency is the key. Pay yourself first every single week. A few key points. Maximize employer matches. Many employers match a percentage of your contributions. This is essentially free money and should be taken full advantage at every opportunity you get. If you switch jobs, always ask for an employer match. Next, choose tax advantage accounts. The traditional 401k, your Roth IRA. You can start small if necessary. Even putting $50 to $100 of a paycheck back is a big move in the right direction. Step 4, pay off medium interest debt. After contributing to retirement accounts and securing your emergency fund, it's wise to focus on medium interest debts like car loans or personal loans with rates between 5 and 12%. While not as urgent as high interest debt, paying these off improves your financial flexibility and reduces risk. You can focus on loans with the highest interest first, just like with credit card debt, then work downward. Consider refinancing options if interest rates are high and you have good credit. Consider eliminating medium interest debt, and then you can start becoming more aggressive with your investing. Because all that, obviously all the interest is going to someone else. That's the bank or wherever making money off of you. And that should be the other way around, where you should be making money off of your finance. You should be making money off of your investments. Step 5, invest in taxable accounts. Once your foundational steps are complete, it's time to invest beyond retirement accounts in taxable brokerage accounts. These accounts provide flexibility because there are no early withdrawal penalties. You can invest in a wide range of assets, stocks, ETFs, mutual funds, bonds, REITs, and more. A few key points. Start with low-cost index funds or ETFs to capture the broad market growth. If you're new, we at DeLozier Investments believe in investing in moats. So Nvidia, Tesla, Eli Lilly, all are highly recommended. You want to get the best company, and that way you can see the best gains. Over time, companies with moats outperform the market. Always focus on diversification to reduce risk. Spread investments across sectors, asset classes, and regions. You can take advantage of dollar cost averaging by investing a fixed amount regularly, regardless of market conditions. Understand the tax implications. Long-term capital gains are taxed favorably. Taxable accounts allow for flexible investing, letting you adjust strategies as life circumstances change. Step 6, explore real estate and alternative assets. With core investments in place, consider diversifying into real estate or alternative assets. Real estate offers cash flow, appreciation, and tax advantages, while alternatives like peer-to-peer lending, commodities, or REITs can further reduce portfolio risk. Really you want to take as much uncertainty and risk out of your investments as possible. That's the overall goal. A few key points. Start with what you understand. If you understand rental properties, you can start there. You can start with REITs or crowdfunding platforms. It's just whatever's in your wheelhouse. Analyze risk versus reward carefully. Real estate requires ongoing management and capital. Use leverage responsibly. Borrowing to invest can amplify gains and losses. Step 7, maximize tax efficiency. As your investments grow, being tax efficient becomes crucial. Minimizing taxes allows more of your money to stay invested and grow over time. A few key points: utilize tax loss harvesting in taxable accounts to offset gains. Consider tax efficient funds like index ETFs, which generate fewer taxable events. Everyone's personality is different. Everyone has different risk tolerance. It's really up to you what you invest in. Always be sure to rebalance your accounts in a tax-conscious manner to avoid unnecessary capital gains. The goal is to keep more of your earnings working for you rather than giving a large portion to taxes. Next, rebalance and monitor your portfolio. Even after building a solid portfolio, ongoing monitoring and rebalancing is essential. Market fluctuations can shift asset allocation away from your target, increasing risk or reducing growth potential. A few key points: review your portfolio at least annually. That's what a lot of people recommend. Personally, we tend to believe that you should be watching your portfolio every single quarter. You should review it. You should look at your portfolio as a top priority. You're working 40 hours a week every week. You should. Some people's life savings gets wiped out from not doing their own homework. So it's crucial for someone to study, put the time in, pay attention, read the news. This is probably the top priority for investors. You have to know what's going on with the market. Rebalance by selling overweight assets and buying underweight. Always adjust for changes in risk tolerance, your life stage, and financial goals. Rebalancing ensures your portfolio remains aligned with your long-term strategy, helping you stay disciplined during market volatility. Dividend-focused investing generates passive income while building wealth. Sector allocation allows you to take advantage of trends in technology, healthcare, and energy. So you always want to diversify. Choose the stocks that have moats. Always do your due diligence if you're buying real estate. Advanced strategies can accelerate growth, but require education, research, and discipline. Always maintain discipline and patience. No matter the strategy, the most critical factor in investing success is consistency and patience. Market fluctuates, and short-term losses are inevitable. By following these steps in order, staying disciplined, and maintaining long-term mindset, you dramatically improve your chance of financial success. So basically, dollar cost averaging is a great way to deal with market fluctuations. You always want to avoid emotional decisions during market swings. Stick to your plan and review it periodically. Always continue learning. And the more you know about investing, the more you stand to make. Patience combined with a smart step-by-step strategy is what turns disciplined investing into long-term wealth. Appreciate everyone watching this video this week. If you enjoyed this video, hit the like and subscribe, and we'll make another video next week. Hope everyone has a very profitable year.